future increases. So future increases are a huge provision in any policy sold to people in their 30s and 40s. Now, when you're buying, you're usually going to be capped to about 60, maybe 65% of your adjusted gross income. So that means if you're making $100,000 a year, you're typically going to be capped at an annual benefit of $60,000 or $5,000 a month, somewhere right around there. And so that means if you are going to be making more money later on down the road, you want to make sure that your benefits are going to be increasing too, so that you can maintain that 60 to 65%. So key point about that figure is that the 60-65% income replacement is going to be tax-free, right, in most cases. So that's a huge benefit added, and why we're not going all the way to 85-90% is because then you would net more money after taxes. But we want to make sure that as your income grows, your benefits are growing right there alongside it. And so these future increases are really important because you're not going to be subjected to the same medical underwriting scrutiny that you would with your original policy. And so you basically just need to show your financial documentation and indicate to the carrier that you are in fact making more money, or maybe you lost your group LTD or some other function that has resulted in sort of an incongruous benefit to income scenario, and you need to beef up the benefit again. So that's how the future increases work. It's usually just like a one-page application with the accompanying financial documentation, and typically those future increases are reviewed every policy anniversary or sometimes every 3 years. So you need to know the interval at which it's going to be available to you. But if you lose group LTD or you have a sudden surge in income, you can almost always then use an off-anniversary future increase option to beef up your benefit and get it where it's supposed to be.